everyone, my name is Weber. For today's video, what are we going to be looking about is about the loans and bankruptcy. So these are the concepts that I believe are the most important in everybody's life journal because probably in some situations you face with these. But what are they actually and what do they impact us? Let's look through this video. So first, the term of loans, what are these? So the term of loans refers to a type of credit vehicle in which the sum of money is lent to another party in exchange for further repayment. So basically this means that in many cases the lender adds interest or finance charges in principal value, which is the borrower must repay in addition to the principal balance. So I believe we've all heard about loans, right? So it's like a kind of credit when the let's say I'm the learner, I'm the lender, and you're the one who borrows me. So the borrower are you. So first you will ask to borrow my money, and I will lend you my money, so that you could charge me back in the future. And so in a lot of cases, usually as I'm the lender, I usually will make profit from taking interest or finance charges to the principal value to so that you could pay more for me, not just the principal balance but also more for me. And so I could benefit from it. Loans may be for specific one-time amount or may be available as an open-ended line of credit up to a specified limit. So loans come in many different forms including secured, unsecured, commercial, and personal loans. So the key takeaway of loans and what are these? So a loan is when money is given to another party in exchange for repayment of the loan principal's amount plus the interest. So lenders will consider a prospective borrower's income, credit score, and debt levels before deciding to offer them a loan. So not all lenders would just easily give you the money. They will look at your income, if you are able to pay the loan or not, the credit score, if you're reliable or not, and debt levels before deciding to offer you the loan. So it's actually a long progress of um, deciding. So a loan may be secured by collateral such as mortgage, or it may be unsecured such as a credit card. Where revolving loans or line can be spent, repaid, and spent again. So just like that. So lenders may charge higher interest rate to risky borrowers. If you don't have as much of like a high credit score, or if you're actually not reliable but you kept saying that please let me lend, then probably they will take a much more amount of money than usual for like others lenders who they believe are believable or who are trustable. So also, what is debt actually? So debt is the money that you owe to others. You might borrow money for different reasons, like buying a car, going to college, or paying for a vacation. And when you borrow money, you usually have to pay it back with interest. So over time, your debt can grow because of interest, fees, and penalties. For example, if you take out a loan for, let's say, $5,000 with an annual interest rate of 5%, so your total debt will grow by 250 each year, even if you don't borrow any more money. So good debt versus bad debt. So how could we know the difference? When you hear the word debt, you might think it's always a bad thing, but that's not true. There's a good debt. Good debt is when you borrow money to invest in something valuable, like your future, or let's say situations like for college, for university, or situations that you want to start your business. Bad debt, on the other hand, is when you borrow money for things that lose value or don't help you grow financially. Like like you get a debt when like you borrow money for a vacation or like for a shopping free with your friends. That's considered as a bad debt. So a good debt is meant to invest in your future. It is to kind of help you achieve your dreams, improve your financial prospects, and add value to your life. Generally, good debts involve borrowing money to invest in a asset that will grow in value over time, generate income, or improve your finances. Just like that. Bad debt will weaken your financial stability. On the other hand, bad debt is when you borrow money for things that don't help you grow financially. For example, if you use a credit card to buy a new TV or a trendy outfit, that is a bad debt. These items lose value quickly and you might end up paying interest on for a long time. So let's say if you buy a new phone for $1,000 and pay 50% interest on it, you actually end up paying more than the $1,000 for the phone, which isn't a smart financial decision at all. So this too will lead to bankruptcy. Have you ever heard of term bankruptcy and wonder what it means? It is a situation where a person or a company is unable to pay back the money they owe to others, so they ask the court for help in finding a solution. So this can involve making a plan to pay up the debts over time or selling the belongings to get money to pay those they own. So uh, there's a lot of things that cause bankruptcy. For some, it is due to overspending or money mismanagement. So they don't organize their money in like a smart budget. And in this case, a long period or poor credit management will ultimately lead to bankruptcy. But for others, bankruptcy may be the result of things they can't control, such as like medical expenses, job loss, divorce, failed business, and etc. So the bankruptcy chapters are in chapter 7 and chapter 13. So in chapter 7, a clean state. Chapter 7 bankruptcy is also called liquidation because it involves selling some of your belongings to pay up your debt. When you file for Chapter 7, a court will look at your income, your expenses, and your assets, which is the thing you own. If you qualify, the court will appoint a trustee who will sell your non-exempt assets to pay back your creditors. So, about Chapter 13, it is our repayment plan. So, Chapter 13 bankruptcy is also known as a recognition or a wage earner plan because it's designed for people who have a regular income but are struggling to pay their debts. Instead of wiping away your debt like Chapter 7, Chapter 13 help you create a plan to pay all of your debt in a period from 3 to 5 years. So, both of them are really helpful, but first, in time. Chapter 7 bankruptcy is typically faster because it takes about 3 to 6 months to complete. Property. In Chapter 7, you may have to sell some of your assets to repay your debt. But on while Chapter 13, you can keep your property as long as you stick to your repayment plan and be able to pay in the estimated time. Eligibility is not everyone is eligible for Chapter 7 bankruptcy. You must pass a mean test that look at your income and your expenses. Chapter 13 bankruptcy is available for those with a regular income who can afford to pay some of their debts. So just like that, you need to calculate which choices you think are suitable for you. So after this video, we've looked at loans, debt, and also about bankruptcy. So thank you so much for listening. Goodbye.